Peace, Prophet people. Welcome back to the Absolute Boss Collective. This video right here is the fourth installment in the Big Homie series. We're going to be talking about an investment guru. We're going to talk about somebody who identified companies based on his wife's shopping habits. And he said his wife was no joke. He said his wife had a black belt in shopping. Okay? We're going to talk about Peter Lynch. Okay, now before we get into Peter Lynch, if you're new to the channel, consider subscribing. Help your brother out. Do me a favor and karate chop that like button and hit that notification bell so you can be aware when I come out with more Big Homies videos. And now, without further ado, let's get into the man, Peter Lynch. Peter Lynch was born on the 19th of January in 1944. He graduated from Boston College in 1965, same year Malcolm X was assassinated. He started an internship at Fidelity Investments in 1966. He was serving as an analyst for the paper, chemical, and publishing industries. Okay? He briefly served in the U.S. Army from 1967 to 1969. In 1969, he was then hired by Fidelity and headed the textiles, mining, metals, and chemical sectors. In 1974, he was named Director of Research, and in 1977, he became a portfolio manager. Okay? He assiduously worked 6 to 7 days a week. We want to talk about grinding. 6 or 7 days a week this man worked. With the help of 2 assistants, he was able to invest in as many as, hold on till you fit it, 1,400 stocks at one time. Now, if you invested 10,000 in the Fidelity Magellan Fund in 1977, he would have managed to give you, to make a return of $280,000 for you by 1990. Okay? When he started heading the Fidelity Magellan Fund, they was holding 20 million in assets. Lynch increased that to 14 billion by 1990. He outperformed the SPX or the SPY, S&P 500, 11 out of the 13 years that he was managing this fund. His return percentage was an annualized 29%. Very respectable. Okay. He wrote 3 books with John Rothschild. Unfortunately, I only read this one. And this was one of the first books that I got when I decided to start messing with this game. Very good book. It set me off on the right path. However, as you guys may know, I was day trading. So a lot of this kind of went under my radar because it was not my trading style. And I'm looking at it now, and there's a lot of stuff in here that I got underlined and stuff like that. So I'm going to be reviewing this going forward. He wrote 2 other books, which I'm going to show here and here. And I'm going to, with tomorrow being my degree day or my born day or my birthday, however you want to call it, I may treat myself to one of those books if it's available on audiobook. So, holla at me and I'll let you know if I did that or not. We're going to get right into the meat of the video, which is the rules. That is the purpose of these Big Homies videos, so we could look at what these guys have done before us and use that to our own benefit. Use their wisdom, equalize it, you know what I'm saying, by reading it and practicing it and exercising it okay, so that you can build up your account, okay? A lot of people come into this game without the proper homework or without the proper study, and they get destroyed. So we're going to make sure that we're using this wisdom in a balanced fashion so that we can build up our accounts, build up our characteristics as traders or investors. So that's what we do, and that's what these videos is about. So without further ado, we're going to get into them. These are Peter Lynch's golden rules for investing. Number one, you have to know what you own and why you own it. Never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. Always look at the balance sheet to see if a company is solvent before you risk your money on it. 3, everyone has the brain power to make money in stocks. Not everyone has the stomach. Facts. If you are susceptible to selling everything in a panic, you ought to avoid stocks and stock mutual funds altogether. Your investor's edge is not something you get from Wall Street experts. It's something you already have. You can outperform the experts if you use your edge by investing in companies or industries you already understand. Shout out to my brother Scientific, because we was just building about that on like Saturday. You know what I mean? So it's great. Everything is connected. 5, over the past 3 decades, the stock market has come to be dominated by a herd of professional investors. Contrary to popular belief, this makes it easier for the amateur investor. You can beat the market by ignoring the herd. Often there is a correlation between success of a company's operations and the success of its stock over a few months or even years. In the long term, there's a 100% correlation between the success of the company and the success of the stock. This disparity is the key to making money. It pays to be patient and to own successful companies. 7, long shots almost always miss the mark. Owning a stock is like having children. Don't get involved with more than you can handle. The part-time stock picker probably has time to follow 8 to 12 companies and to buy and sell shares as conditions warrant. There don't have to be more than 5 companies in a portfolio at any one time. 9, if you can't find any companies that you think are attractive, put your money in the bank until you discover some. 10, never invest in a company without understanding its finances. The biggest losses in stocks have come from companies with poor balance sheets. 11, avoid hot stocks and hot companies. Great companies in coal, non-growth industries are consistent big winners. With small companies, you're better off to wait until they turn a profit before you invest. 13, if you invest $1,000 in a stock, all you can lose is $1,000, but you stand to gain $10,000 or even $50,000 over the time you're patient. You need to find a few good stocks to make a lifetime of investing worthwhile. 14, in every industry and every region, the observant amateur can find growth companies long before the professionals have discovered them. 15, a stock market decline is as routine as a January blizzard in Colorado. If you're prepared, it can't hurt you. A decline is a great opportunity to pick up the bargains left behind investors who are fleeing the storm in panic. There is always something to worry about. Avoid weekend thinking and ignore the latest dire predictions of newscasters. Sell a stock because the company's fundamentals deteriorate, not because the sky is falling. 17, nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you're invested. 18, if you study 10 companies, you'll find one for which the story is better than expected. If you study 50, you'll find 5. There are always pleasant surprises to be found in the stock market, companies whose achievements are being overlooked on Wall Street. 19. If you don't study any companies, you have the same chance of success buying stocks as you do in a poker game if you bet without looking at your cards. 20. Time is on your side when you own shares of superior companies. You can afford to be patient if you miss Walmart in the first 5 years. It was a great stock to own in the next 5 years. Time is against you when you own options. And those rules can be found in another book, one I don't have, Beating the Street. Okay? I also have some of Peter Lynch's investment principles. Peep this. Never invest in an idea that you can't illustrate with a crayon. You can't see the future through a rearview mirror. When yields on long-term government bonds exceed the dividend yields of the S&P 500 by 6% or more, sell stocks and buy bonds. The best stock to buy is the one you already own. His investment philosophy. He believed that individual investors have advantages over professionals. Individuals have more freedom to act independently without being tied down by committees, trustees, and superiors. He used a bottom-up approach to discovering good investment opportunities. Okay? And it was a 3-step process. 1, dig up possible investments one by one. 2, get familiar with the company and its business. And 3, conduct fundamental analysis to verify growth and profitability. Okay? He divided stocks into 6 different stories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset opportunities. Okay? And lastly, what I'm going to give y'all before I get up out of here is some investment myths that he was talking about. So hold fast. Let me get that for you. Peter Lynch's investing myths. It can't go any lower. How high can it go? They always come back. How much can I lose? Darkest before the dawn. I will sell after a rebound. I own conservative stocks. Money lost because of not buying. I must be right or I must be wrong. Avoid long shots. Okay? So, as my shirt says, if you're trying to read it. It says, proper education always corrects errors. So we have to understand that the stock market is going to be inherent with errors. Stock prices are going to have errors because they're all based on human emotion, human decision, human behaviors is what determines a lot of the mechanics of the stock market. Okay. And these rules that I'm laying out here, it's to help guide you. You know what I'm saying? You're not gonna be able to win every investment or every trade. However, you have a guideline so that when you get into trouble, when you get into murky water, you're able to now use the wisdom, right, and figure out a way to manage that particular situation. It's all about balance. Some of it is going to be, trusting your gut, and some of it is going to be trusting the chart or trusting the technicals. It's going to be a balance of that so that you can build and increase your account value, increase your net worth, increase your lifestyle. That's what we're about here at the Absolute Boss Collective, okay? This is your brother in trading and investing. Signing off for the big homies, episode 4, Peter Lynch. Peace.